Imagine, if you will, a market where $1 trillion changes hands.
Right, just a staggering amount.
And not over a decade, not even over a year, but every single day.
$1 trillion a day. It's almost impossible to picture.
Exactly. It's this massive arena that quite literally follows the sun around the globe. Like it wakes up in Sydney and Tokyo, right? Then it moves through Frankfurt and London.
Yeah, and then it crosses the Atlantic over to New York and Chicago before jumping right back across the Pacific.
It is the interbank currency market. And just to put that kind of scale into perspective for you listening, the entire volume of the world's stock exchanges, like all of them, looks like an absolute rounding error in comparison.
Oh, totally. A complete rounding error. When people think of global finance, they usually picture the floor of the New York Stock Exchange.
Right. Guys yelling, ringing the bell.
Exactly. They picture equities, corporate bonds, maybe commodities like gold or oil. But the true behemoth, the absolute baseline of global liquidity, is foreign exchange, the currencies themselves.
It's just massive. You are stepping into a world where a single individual might hold a $3 billion position.
Which is terrifying.
And where a tiny microscopic miscalculation in liquidity can cost you $30 million in exactly 8 minutes.
Yeah, 8 minutes. That's all it takes.
So today, we are taking you inside the minds of the people who navigate these oceans of capital.
And what's truly fascinating here is that despite these staggering algorithmic complexity, the incomprehensible amounts of money swashing through these banking networks, the ultimate drivers of this market are remarkably human.
Highly vulnerable to human emotion, actually, which is exactly why we're doing a deep dive today into Jack Schwager's classic work, The New Market Wizards, Conversations with America's Top Traders.
It's such a brilliant book.
It really is. And Schwager did something totally unprecedented. He didn't just interview the most elite, high-stakes players in the financial world to ask for, hot stock tips.
Right. No. If you're listening to this hoping for a get-rich-quick formula, you are definitely in the wrong place.
Totally the wrong place. Our mission for this deep dive is to extract the psychological blueprints, the mathematical paradoxes, and really the raw human drama of decision-making under the most extreme pressure imaginable.
Because while the context of Schwager's conversations is trading, the actual subject matter is the architecture of the human mind.
Ooh, I like that.
Well, it's true. People naturally gravitate toward looking for a magic bullet. They want a secret system.
Like an algorithm that will guarantee success.
Exactly. Whether that's in the financial markets or building a tech startup or just navigating their personal lives. But the overarching truth that emerges from these interviews is that the real secret to mastering any highly complex system lies in confronting our own psychological flaws.
The market is just a mirror.
An unforgiving mirror. It reflects your greed, your fear, your ego, and your sheer inability to admit when you are objectively wrong.
Okay, let's unpack this, because right out of the gate, Schwager asserts that markets are absolutely not random. They are driven by human behavior.
And human behavior, especially the behavior of massive panicked crowds, is anything but random.
Right. So to set the stage for how someone actually learns to navigate this kind of chaos, Schwager opens his book with this incredible fable. It's called The Jade Master.
Oh, I love this story.
It's so good. I want to start here because it perfectly frames the difference between superficial knowledge and deep mastery. So the story goes like this. A young man walks 5 miles through the freezing snow to knock on the door of this old jade master.
Dedicated kid.
Yeah, he says, I want to learn about jade. So the Jade Master invites him in, hands him a green stone, tells him to hold it tightly, and then proceeds to talk to the young man about tree frogs.
Not about jade, just tree frogs.
Literally just frogs. After a while, the student gets frustrated, interrupts, and says, look, I'm here to learn about jade, not frogs.
Fair enough.
Right. But the Jade Master calmly takes the stone back and tells him to go home and return in a week. So the student comes back the next week. The Jade Master gives him another green stone to hold and continues his story about frogs.
And the kid interrupts again.
Again. And again, he is sent out into the cold. This goes on for weeks. Slowly, the young man just gives up his expectations. He stops interrupting.
He just surrenders to the process.
Exactly. He learns to brew the tea. He sweeps the floors. He just sits there holding the stone while the master talks about everything under the sun, except the one thing the student came to learn.
Which is the entire point.
Right. Finally, spring arrives. The young man is sitting there. The master hands him a stone, and the young man immediately says, Master, the stone I hold is not genuine jade.
It's such a brilliant prologue. And what makes it so relevant to navigating complex systems is that it highlights the absolute necessity of subconscious processing.
Over conscious rule following.
Yes, you cannot master a dynamic environment by memorizing a checklist. If you give a novice trader a checklist of technical indicators, they will fail.
Because the context is always shifting.
Exactly. What the Jade Master was doing was forcing the student to build a tactile subconscious database of what real jade feels like.
The density, the temperature.
The texture, yeah.
Yeah.
Once that baseline was fully integrated, the anomaly, the fake stone, registered instantly on an instinctive level.
It reminds me of the difference between trying to learn a language by memorizing a syntax textbook versus, moving to a foreign country and just immersing yourself.
That's a perfect analogy.
You don't consciously parse the grammar of a native speaker. You just eventually develop an ear for when a sentence sounds wrong.
Right? You just feel it.
But Schwager immediately contrasts this profound instinctual mastery with his own highly relatable failures. He actually shares a story about a time he completely lost his own internal compass.
Oh, the house-building disaster.
Yes. So he decides to build a house. Now, anyone listening who has built a house knows it is an absolute financial sinkhole.
Just endless expenses.
You constantly find yourself saying, oh, it's just another $2,000 for this plumbing fixture.
And it adds up so fast.
It really does. So Schwager decides to put in an indoor swimming pool. And to pay for it, he drains his trading capital. He completely liquidates his account, leaving himself with what professionals call scared money.
And operating with scared money is perhaps the most dangerous psychological state you can possibly be in when making decisions.
Because you can't afford to lose it.
Right. If the capital you are risking is too important to your baseline survival, like paying for the roof over your head or the indoor pool under it, you are completely doomed. The physiological response to that kind of stress literally degrades your cognitive function.
Because your amygdala takes over. You are in full fight or flight mode.
Exactly. When you are operating with scared money, the fear of loss completely clouds your analytical judgment.
Yeah.
You'll actually miss out on the best opportunities because great opportunities inherently carry a degree of uncertainty.
And your brain just rejects the risk.
Totally rejects it. And if you do manage to get into a good position, the moment the environment shifts slightly against you, which is perfectly normal in any market, you will panic and abandon the strategy prematurely.
Or, conversely, if you have a tiny profit, you take it immediately out of fear that it'll vanish.
Right. Ensuring you never capture the larger trends you actually need to offset your inevitable mistakes.
Yeah.
And ironically, this overconcern about losing often causes people to freeze entirely when a decision goes terribly wrong.
Like a deer in headlights.
Cool.
Which leads us directly into his disaster with a friend he calls Harvey.
Oh, Harvey.
Yeah, so Schwager is in this highly vulnerable state, trading with scared money, and he gets a call from his friend Harvey. Now, Harvey is a strict devotee of Elliott wave analysis.
Which is intense.
Very. For you listening, Elliott wave is this highly complex market theory that attempts to map all human crowd behavior into a grand, repeating structure of predictable price waves.
It's very rigid.
Super rigid. So Harvey tells Schwager, with absolute unwavering certainty, that the British pound is at its ultimate peak. He calls it the fifth of a fifth, meaning the absolute final wave of the trend.
The top of the mountain.
Right. He says the currency is going to collapse and never look back.
And this is where the certainty of a complex theory becomes a trap. Schwager, who normally has a strict rule against listening to other people's opinions, is tempted.
He's exhausted.
He is. He's stressed about the construction costs. His cognitive load is maxed out. He just wants someone else to do the heavy lifting. He wants an easy win.
So he violates his own core principle.
He does. He decides to piggyback on Harvey's trade, but he goes a step further and tells Harvey, I'm following you all the way. You have to tell me when to get out because I'm completely surrendering my decision-making to you.
Which is the original sin here. He abdicates responsibility entirely.
Never a good idea.
Never.
Yeah.
So Schwager shorts the British pound, meaning he places a bet that the price will go down right before the market closes for the weekend. Monday morning rolls around and the pound opens a massive 220 points higher.
Ouch. It gaps right up.
The trade is instantly horribly wrong. Schwager's own internal compass, his subconscious jade recognition we talked about, is screaming at him to just cut the loss.
But what do?
He calls Harvey.
And Harvey, who is emotionally married to his wave theory, says, oh, it's just a minor wave extension. We are very close to the top. I'm staying short.
Unbelievable.
So Schwager ignores his own internal alarms and stays in. The market keeps climbing. Friday comes, bad economic news comes out for the British economy, the price of the pound dips briefly, and then violently rallies back up.
I want to pause on that because that is a crucial market mechanic. When bad news comes out and the market ignores it and goes up anyway, that is a screaming signal that the underlying demand is incredibly strong.
Oh, it is one of the most reliable indicators of a powerful trend. If a market won't go down on bad news, you do not want to be betting against
Yeah,
it.
it's a freight train.
Exactly. And again, Schwager sees this, he knows what it means, he wants out. But again, he calls Harvey.
And Harvey is still stubbornly bearish, so Schwager stays in.
The next week, the market is up hundreds of points again. Harvey calls and triumphantly announces, "Good news. I completely redid my wave analysis, and we are definitively at the top."
Oh man, Schweiger is just groaning internally. He realizes the theory can just be endlessly adjusted to justify the losing position.
You can make the chart say whatever you want it to say.
Right, so he eventually throws in the towel and takes a massive hit. The pound, by the way, continued to go up for another 7 months.
This whole sequence is a masterclass in how one breakdown in discipline cascades into a series of compounding failures.
It's a domino effect.
Exactly. It started with fatigue and the desire for an easy out that scared money phenomenon. That led to the sin of violating his own rule about outside opinions.
Which led to the abdication of his risk management.
And finally, it culminated in the ultimate sin of ignoring, screaming, objective evidence from the environment that his hypothesis was wrong. The environment was providing clear feedback, but he chose to filter it through someone else's flawed model.
And Schwager actually provides another staggering analogy for this specific behavior, this total refusal to accept a small loss when the environment changes. He compares a novice trader caught in a losing position to Saddam Hussein's invasion of Kuwait in 1990.
Which is a very intense analogy.
It is. And to be absolutely clear to you listening, we are looking at this strictly as a behavioral and strategic analogy. We are evaluating the mechanics of a decision-making process under pressure.
Right. We are not making any political or ethical commentary on the war itself. We're staying totally impartial on the politics.
Exactly. It's just a lens for strategy. So looking at it purely analytically, Hussein's initial move into Kuwait was, from his strategic perspective at the time, a good trade with solid fundamental reasoning.
Right. He wanted to drive up global oil prices, eliminate a neighboring country that was exceeding OPEC quotas, annex those fields, and gain a highly strategic port.
The perceived upside was enormous.
And initially, the risk seemed incredibly low. The early diplomatic signals he received from the West were widely interpreted as ambivalent.
Right, the setup looks good to him, so he puts the trade on. He invades. But then the market, the geopolitical environment shifts completely. The U.S. immediately commits troops to Saudi Arabia, and the UN passes resolutions demanding total withdrawal.
And at this exact moment, Hussein had the opportunity to exit the trade with a profit, or at least a geopolitical victory.
He could have negotiated.
He could have used the occupation as leverage to get a withdrawal in exchange for some border concessions, debt forgiveness, or port rights, but he didn't.
He became attached to the maximalist outcome.
He stood pat. Then, the environment moves further against him. U.S. forces double to over 400,000 troops. That's a highly credible, undeniable threat of forced removal.
And Hussein just ignores the signal.
The trend turns deeply negative. A January 15th deadline is set by the coalition. At this point, the profit potential of the invasion is totally gone.
But he could have still walked away with a break-even trade, right? By simply withdrawing his forces and saving his military infrastructure.
Exactly. Instead, he holds out. He operates on hope. He hopes that if he just waits long enough, the coalition will fracture or the other side will blink.
And that is the precise psychology of a failing decision maker caught in a deteriorating position.
It really is. You start out saying, "I'll get out when I capture the whole market." Then the situation degrades and you say, "I'll get out when I get back to break even."
Just let me get my money back.
Right. Then it degrades further and you say, "I'll get out at the next minor victory." And that relative acceptable high just keeps moving lower and lower as you rationalize the pain.
Hussein waited until the aerial bombardment started. His military infrastructure was decimated, and then finally capitulated under the absolute worst terms imaginable.
The behavioral principle here is brutal. If you cannot bring yourself to take a small, manageable loss when the facts change, the system will eventually force you to take a catastrophic loss.
Wow. Okay, I want to transition from the psychology of catastrophic loss to the absolute stratosphere of survival and winning. Let's talk about Bill Lifshitz.
Ah, the Sultan of Currencies.
Yes, this guy was Salomon Brothers' largest and most successful currency trader in the 1980s. To give you a sense of scale, Lipshitz's department eventually had $80 billion with a B in credit lines with international banks.
It's mind-boggling.
And he didn't start at Harvard Business School. He started as an architecture student at Cornell.
His background is completely unconventional, which is actually a running theme among these top performers. While at Cornell, he inherited a portfolio of odd-lot stocks worth about $12,000 from his grandmother.
So not a massive fortune, but a good chunk of change for a student.
Right, and he started trading them while supposedly studying architecture. He
Yeah.
became utterly obsessed with the flow of information. He'd spend hours in the library reading obscure corporate reports and watching a delayed stock ticker on a local Ithaca cable channel.
Just absorbing the rhythm of price action.
Exactly, building that subconscious jade recognition. And over 4 years, he turned that $12,000 into $250,000.
Which is incredible. But
Yeah.
here is the critical moment. He blew it all.
Almost the entire $250,000 just vaporized in a matter of days.
He got caught in the famous 1982 Granville reversal. For you listening, Joe Granville was a massively influential financial newsletter writer in the early 80s. When Granville said sell, the market sold.
People listened to him.
They really did. So Lipschitz was heavily shorting the market buying put options and pressing his bets all the way down, anticipating a total collapse.
We should probably clarify the mechanics there for a second.
Good idea.
Buying put options is functionally a bearish bet, similar to shorting a stock, but with a crucial difference. When you short a stock, your potential loss is technically infinite if the stock just keeps going up.
Right.
But when you buy a put option, your risk is strictly defined.
Yeah.
You can only lose the premium you paid for the option itself,
So it's safer, in theory?
in theory. However, Lipschitz had so aggressively leveraged his account, pouring literally all his capital into these options, that he effectively created a scenario where a sudden market turnaround would wipe out his entire premium base.
And that's exactly what happened.
The market hit a tipping point where sellers were just exhausted, and it violently reversed upward in a massive short squeeze. His account was completely obliterated.
I mean, most people would be psychologically destroyed by that. They would walk away from the markets forever, blaming Joe Granville or the system being rigged.
But Lipschitz did something remarkable.
He didn't view it as a failure of his core analytical ability. He viewed it as a massive, glaring failure of his risk control.
Right. He realized he had become wildly over-leveraged and had completely failed to protect his capital base.
That total wipeout paradoxically became the foundation of his future success, because it taught him, in the most agonizing way possible, that risk management is the single most important element of longevity.
And furthermore, it convinced him to separate his personal psychological needs from his professional capital.
Oh, this is huge.
It is. Once he was hired at Salomon Brothers, he stopped trading his personal account entirely. He just put his paycheck in a safe money market fund and focused 100% of his aggressive, risk-taking energy on the firm's capital.
By severing his personal livelihood from his trading decisions, he completely eliminated the scared money dynamic that destroyed Schwager.
Exactly. He could evaluate a $30 million position with absolute clinical detachment because his mortgage wasn't depending on it.
I want to dig into the culture at Salomon Brothers in the 80s because it is legendary and it clearly shaped how Lipschitz operated. This is the era detailed in Michael Lewis's Liar's Poker.
Oh yeah, the Wild West.
Totally. Lipschitz gets into their famous training program, and the culture is hyper-aggressive, intensely relationship-driven, and just obsessed with testing people.
Constantly testing.
There's this amazing anecdote where John Gutfreund, the legendary chairman of Salomon Brothers, who Lipschitz says could smell death at 100 paces, walks up to Lipschitz.
And Lipschitz is just a lowly trainee at this point.
Right. The trading floor is practically empty. Gutfreund asks, where did the franc close? Lipschitz, trying to be precise, asks, which one, the Swiss franc or the French franc? And Gutfreund just stares right through him and says, both.
And then a year later, the exact same scenario plays out. Empty floor. Freund walks up, asks, where did the franc close? Lipschitz says, which one, the Swiss or the French? And without missing a beat, Gutfreund says, Belgian.
Okay, so my initial reaction to this is that it sounds like classic 1980s Wall Street hazing. It sounds like an executive just bullying a junior employee on an empty floor to flex his ego.
Sure, it looks like that on the surface.
But is there a structural reason you'd want your firm operating with that kind of tension? Is he trying to build, like, a high reliability organization, like an air traffic control center where everyone is constantly on edge?
That is exactly the right lens to view it through. It is a highly calculated stress test designed to forge a specific culture.
Wow.
By asking a trainee a hyper-specific, unexpected question about a secondary currency like the Belgian franc, Goodfreund is testing their baseline poise. He's testing their breadth of knowledge and their ability to function under the immediate, unblinking scrutiny of power.
It sets a standard.
It sends a shockwave throughout the entire firm. No detail is too small, and you are expected to know the granular reality of your markets perfectly at all times, no matter your rank.
So it wasn't really about the Belgian franc at all?
Not at all. It was about passing on a culture where information and risk were treated with life or death seriousness.
And Lipschutz thrived in that pressure cooker, specifically in the brand new foreign exchange department. Now, you have to understand the context here. At the time, Salomon Brothers was a bond trading powerhouse.
Nobody there really understood currencies.
But Lipschutz realized that the interbank currency market wasn't an exchange-traded market where you just plug an algorithm into a computer. It was an over-the-counter, 24-hour global web of human relationships.
This structural difference is crucial to understand. On the Chicago Mercantile Exchange, if you want to buy futures, you route your order to a centralized pit or a matching engine. You don't need to know the person on the other side.
It's anonymous.
Completely. But the interbank cash market is literally a decentralized network of dealers at major banks calling each other directly on the phone or over telex.
So it's heavily reliant on trust and rapport.
Exactly. If you need to move $100 million in the middle of the night, the dealer on the other end, in Tokyo or London, doesn't legally have to give you a tight price. They don't even have to pick up the phone. Lipschutz understood that liquidity, the lifeblood of trading, your ability to enter and exit massive positions smoothly, depended entirely on being deeply embedded in the social fabric of the international banking community.
He actually joked about how the typical Salomon bond traders were these pristine white wine and arugula salad guys wearing expensive suspenders.
The typical Wall Street elite.
Exactly. But the foreign exchange dealers at the international banks were rougher around the edges. They were, go out for pasta and dribble marinara sauce all over yourself, guys.
And Lipschutz adapted to his environment. He went out drinking with them. He built those relationships.
He even got the very first at-home Telerate, quote, screen installed in his apartment so he could monitor the Asian markets at 3 a.m. He literally wired himself directly into the nervous system of the global information flow.
And the immense value of being plugged into that nervous system is beautifully illustrated by his strategy when the Berlin Wall fell.
Oh, this is a great example.
The immediate reflexive assumption of the financial press and the broader market was that massive Western capital would flow into East Germany to rebuild it.
Right, which would drive up interest rates and cause the West German Deutschmark to skyrocket. That was the consensus fundamental view. Capitalism wins, Germany unites, the economic engine roars. Buy the mark.
But because Lipschutz was constantly on the phone with dealers all over Europe, having these informal, unscripted conversations, he caught a subtle shift in the psychological narrative long before it appeared in any official economic data.
What was he hearing?
He started hearing grumblings. The East Germans, who were accustomed to a heavily subsidized socialist system, were suddenly realizing the harsh realities of integration. They were saying, wait, the state isn't paying our medical bills anymore. We have to compete and work as hard as the West Germans.
Oof. Reality check.
And conversely, the West Germans were realizing the staggering tax burden they were about to shoulder to modernize the East.
The reality of the hangover was setting in.
Exactly. The realization began to dawn across the continent that rebuilding Eastern Europe was not going to be an immediate economic boom. It was going to be an incredibly long, expensive, and socially painful slog.
So what did he do?
As soon as Lipschutz sensed the investment community waking up to this nuanced reality, he predicted the Deutsche Mark would actually drop, and he positioned a massive short trade accordingly.
He wasn't trading the historical event itself. He was trading the shifting psychology of the crowd digesting the event.
It's a profound lesson. It's never just the news. It's how the market mechanism digests and interprets the news.
Let's look at another story that shows how deeply he understood the actual mechanics of the ecosystem he was playing in. The fat finger trade.
Oh, this one is wild.
It is. Lipschutz is trading currency options on the Philadelphia Stock Exchange. A specialist on the floor, the person responsible for making the market, makes a massive mathematical error and misquotes an option price by a full 100 points.
It's an absurdly wrong off-market price.
Lipschutz immediately buys 50 contracts. The specialist, totally oblivious to his error, is still offering it at that price, so Lipschutz buys another 50. And another 50.
He is locking in a massive, totally risk-free arbitrage profit.
Explain arbitrage real quick for the listener.
Sure, an arbitrage exists when you can buy an asset in one market and simultaneously sell a mathematically equivalent asset in another market for a higher price, locking in the difference without any market risk.
Free money.
Essentially. Because the option was so deeply underpriced compared to the actual cash value of the currency at that exact second, Lipschutz could buy the cheap options and immediately take an offsetting position in the actual currency market.
Creating a perfectly hedged, guaranteed windfall. He essentially caught the specialist in a mechanical trap where the specialist had guaranteed his own firm's destruction.
Right. And when the specialist finally realizes the magnitude of what he's done, he calls Lipschutz agonizing, knowing that this single catastrophic mathematical error is going to bankrupt his entire firm.
And Lipschutz, who is notoriously known as one of the most ruthless, give-no-quarter traders on Wall Street, does something totally out of character.
He breaks the trades.
He voluntarily unwinds the entire massive profit and lets the guy off the hook. So the question becomes, why did he do that? Did he suddenly grow a conscience in the middle of the trading day?
As Lipschutz explicitly states, it wasn't a sudden attack of morality or charity. It was a cold, highly calculated long-term business decision.
Ah, playing the long game.
Precisely. At the time, the currency options market on the Philadelphia Exchange was in its absolute infancy. It was a fragile, developing ecosystem that was currently making Lipschutz and Salomon Brothers very, very rich.
So if he enforced those trades and bankrupted the primary market maker on the floor,
It would severely damage the entire exchange.
Sure.
It would collapse the very liquidity pool he was trying to swim in, scaring away other participants. He sacrificed a massive short-term windfall to preserve the structural integrity of the ecosystem that guaranteed his long-term wealth.
think about how that applies to any business. Are you extracting so much aggressive value in the short term, squeezing your suppliers or your partners, that you are destroying the marketplace you rely on for survival?
Ecosystem preservation is everything.
And speaking of going to absolute extremes to operate within this global ecosystem, we have to talk about the G7 Sardinia score.
This sounds like a movie.
It really does. Lipschutz is on vacation in Sardinia. It's the mid-1980s, the era of the Plaza Accord and the Louvre Accord, where global superpowers were actively trying to manage currency values.
Right.
Lipschutz is so disconnected, he doesn't even know what the G7 is at this point.
Right.
Meanwhile, the finance ministers of the G7 nations hold a historic secret weekend meeting and announce a massive coordinated central bank intervention to artificially drive down the value of the US dollar.
It was a monumental structural intervention in global monetary policy. The intent was to weaken the dollar to help U.S. exports. And when the Asian markets open on Monday morning, it is complete bedlam.
The dollar is in a violent freefall.
And Lipschutz is lying on a beach in Italy, totally oblivious.
He finally decides to call his office in New York just to check in, but it takes him hours to get an international overseas line from this remote island.
This is pre-cell phone era, obviously.
Very much so. He finally gets through to his London office and finds out the global financial system is on fire. And worse, his right-hand man, Andy, who never gets sick, is at home in New Jersey, flat on his back with a raging fever.
But Andy was a consummate professional. Despite being violently ill, Andy recognizes the sheer magnitude of the historical event. He knows they have to position the firm. So he starts hitting bids in the New Zealand market.
Why New Zealand?
Because of time zones, the New Zealand market is the very first to open after the weekend. And it is notoriously thin, meaning there are very few participants, very little capital flowing.
So any large order can cause prices to whip around erratically.
Right. But because Lipschutz and Salomon Brothers had spent years cultivating deep personal relationships with dealers in places like New Zealand, Andy was able to get banks to actually answer the phone and quote him prices in the middle of a historic panic.
And the quotes were absurdly wide because the local banks were terrified of the volatility. But Andy aggressively sells $60 million into that panic anyway.
And the logistical setup for this is pure 1980s chaos.
Oh, it's the best part. Lipschutz has this one precious, crackling phone line open from his hotel in Sardinia to Andy's house in New Jersey. Andy sends his wife to the local Radio Shack to buy massive spennies of extension cords.
So he can have one phone line to Sardinia, one line open to the options floor in Philadelphia, and a third line physically borrowed from his neighbor's house, connecting him to their spot currency broker.
They keep these lines open for 6 solid hours, shouting across the globe, calculating currency cross rates in their heads, trading aggressively into the central bank intervention.
They ended up making $6 million for the firm that single day.
Unbelievable.
It perfectly encapsulates the required commitment for mastery. There are no excuses in that tier of performance. Sickness, vacations, remote islands, technological hurdles, none of it matters when the environment presents a generational opportunity. You engineer a solution.
But of course, the market doesn't always validate your brilliance, which brings us to the $3 billion nightmare.
Oh man, this is a heavy one.
This is a study in crisis management. Lipschutz is carrying a staggering short position against the Deutschmark, that $3 billion.
That's billion with a B.
Yes, the market has been quiet, volatility is extremely low, so he has dramatically sized up his position to capture microscopic moves in the exchange rate. Suddenly, without warning, Mikhail Gorbachev gets up at the United Nations and makes a surprise speech announcing massive unilateral Soviet troop reductions.
And the market instantly interprets this geopolitical shock as incredibly bullish for the US dollar.
Why is that?
The logic is straightforward. If the Soviets reduce troops, the U.S. can drastically cut defense spending, which helps alleviate the ballooning budget deficit, making U.S. assets more attractive.
Ah, okay.
So the dollar violently spikes upward against the mark. Lipschutz is caught completely off guard, holding a $3 billion bet in the exact opposite direction.
Lipschutz's first instinct is to try and bully the market. He tries to cap the rally by dumping $300 million into the New York afternoon market, hoping the sheer size of his sell order will intimidate other participants and cause the market to back down.
But the momentum is too strong. The market just swallows his $300 million hole and keeps running.
In the span of exactly 8 minutes, Lipschutz watches his position bleed $30 million.
And this is where we see the absolute brilliance of Salomond's executive management culture and how a high-reliability organization handles a catastrophic failure in real time.
Lipschutz is terrified. He realizes he has fundamentally misjudged the liquidity of the afternoon market. He knows he cannot buy his $3 billion position back to stop the bleeding without pushing the price even higher against himself.
It's like trying to force a fire hose through a straw.
Exactly. He walks over to the president of the company, Tom Strauss. He tells Strauss he's down somewhere between $70 and $90 million on the day.
Think about that conversation for a second. You have to tell your boss you just lost $90 million.
I would be shaking.
But Strauss doesn't scream. He doesn't throw a phone. He doesn't fire him on the spot. He looks at Lipschutz and calmly asks, "What do we want to do about this?"
We, not you. What do we want to do?
That single pronoun is everything. In a moment of absolute crisis, Strauss instantly removes the fear of career destruction from Lipschutz's mind. By saying we, he aligns the firm with the trader,
allowing Lipschutz to drop his defensive posture and focus entirely on solving the complex mathematical and psychological problem of the market depth.
Exactly. So Lipschutz tells him the plan is to wait for the Tokyo market to open in a few hours, where there is deeper liquidity, to begin covering the position.
And Strauss simply says, do what you need to do.
Because Lipschutz isn't panicked by management into executing a desperate forced trade in a highly illiquid afternoon market, he waits. He endures the agonizing mark-to-market pain watching the theoretical accounting value of his loss grow on the screen.
Which takes nerves of steel.
It really does. But by the time Tokyo opens, the initial shockwave of the Gorbachev speech has been fully priced in. The dollar's rally has exhausted itself and the price begins to settle. He methodically covers the massive position through the Asian and European sessions and manages to engineer the $90 million hole down to an $18 million loss.
The lesson there is profound. It's about the discipline of not panic exiting a bad position if the market mechanics are stacked against you.
Right. If you have a massive position, your own desperate efforts to exit in a thin market will cause the price to move against you at an accelerating rate.
You have to wait for the depth of the market to return, even if it requires immense emotional control to sit on your hands while the house is burning.
Emotional control is a perfect bridge to our next subject, Randy McKay.
The veteran trend follower.
Yes. And his psychological origin story is completely different from Lipschutz's academic path. McKay was drafted into the Marines in 1968 and sent straight to the jungle in Vietnam.
What a shift.
Yeah. He was a highly intelligent kid, so he gets assigned to an artillery unit, where his job is calculating the complex atmospheric variables. wind shear, temperature, earth rotation, humidity, to manually adjust artillery fire coordinates.
Wow.
And he had to do this math in his head under fire in roughly 9 seconds.
That is unimaginable pressure. But the truly transformative aspect of Vietnam for McKay was not the mathematical pressure, it was the cognitive dissonance that shattered his worldview.
Tell us about that.
He describes a moment standing guard duty in the pitch black, utterly terrified, and having the sudden realization that the enemy waiting in the bushes was likely just another terrified teenager who was drafted and following orders exactly like he was. He came to the profound realization that the entire enterprise of war was absolute insanity. More importantly, he realized that the authorities, the generals, the politicians, the people ostensibly in charge of the system, do not always know what they are doing.
That kind of realization completely shatters a young person's adherence to consensus thinking. He went to Vietnam as a conservative, straight-down-the-line rule follower who trusted authority. He returned as a profound, skeptical, independent thinker.
And again, keeping our neutral analytical framework, the geopolitical context of the war isn't the primary focus here. It's the internal psychological paradigm shift.
Right. He learned to question the established narrative. He learned that the crowd and even the leadership can be marching in lockstep toward a cliff.
And that independence, that willingness to stand apart from the crowd, is the hallmark of a great trader. When McKay returned and eventually found his way onto the floor of the Chicago Mercantile Exchange, he brought that skeptical, analytical mindset with him.
He started trading currency futures in the 1970s when the market was brand new, highly inefficient, and totally illiquid. He started with a meager $2,000 stake and turned it into $70,000 in his first 7 months.
His core philosophy on how to trade is wonderfully simple to explain, but incredibly hard for human psychology to execute. He focuses entirely on catching the easy part of the trend.
Yes, he explicitly avoids trying to pick the absolute bottom or the absolute top of a market move.
Which is the exact opposite of what our egos want us to do. Amateurs want the bragging rights of buying the absolute lowest tick and selling the absolute highest tick. We want to feel like we outsmarted the universe.
But McKay argues that the beginning of a move is inherently too uncertain. You don't know if it's a genuine trend emerging or just a temporary random fluctuation. It's statistical noise.
Makes sense.
And the end of a move is far too volatile, as early adopters are fighting to take profits and latecomers are panic buying. The middle, the sustained momentum, the meat of the move, is where the real capital is accumulated safely.
Think of it like boarding a moving train. You don't stand on the tracks in front of it to try and stop it. That's trying to pick a top. And you don't run desperately down the tracks chasing it as it leaves the station. That's trying to pick a bottom.
You wait patiently on the platform, you let it accelerate to a steady, predictable speed, and you jump into an open car as it cruises by.
He proved the immense value of this philosophy with his monumental 1976 British pound trade. The UK government, facing severe economic pressure, publicly announced they would actively intervene to cap the pound at an exchange rate of $1.72.
The market rallied to $1.72, fell back, rallied back to $1.72, and just sat there, pinned against the ceiling.
The consensus, the crowd, trusting the government's authority, said the government promised to cap it, they have the reserves, it's a safe short, sell it.
But McKay, the independent thinker, looked at the actual price action and realized the market was basically locked limit up. Now, we need to explain what limit up means for the listener.
Right. In regulated futures markets like the CME, the exchange enforces daily limits on how far a price can move up or down in a single session to prevent total systemic panic.
If a market is locked limit up, it means there's an overwhelming demand to buy at the maximum allowable price and absolutely zero willingness from anyone to sell at that price.
Trading simply halts because the order book is entirely one-sided.
So McKay looks at this and realizes a profound structural truth. If the British government is explicitly threatening to cap the price and flood the market with supply, and the market still won't break lower, the underlying organic demand must be oceanic.
The pressure building underneath that $1.72 cap is explosive.
So he ignores the consensus, he ignores the government threats, and he goes massively long. He buys 200 contracts, which was a massive position for him at the time.
He is so heavily invested and so nervous that he is waking up at 5 a.m. in Chicago, calling the Bank of England in London, pretending to be a big-shot institutional banker just to get real-time price quotes.
And his independent thinking paid off spectacularly. The pressure finally broke the dam. The pound blasted right through the government's $1.72 a cap and rocketed relentlessly to $1.90.
McKay rode the easy part of that trend for months, letting the momentum do the work. eventually clearing $1.3 million on the trade.
But what truly separates a wizard from a one-hit wonder is not how they handle a winning streak. It's how they handle sudden, violent adversity.
Contrast the pound trade with how he managed a crisis in 1978.
The Carter administration unexpectedly announced a massive dollar rescue plan over a weekend. McKay was heavily long foreign currencies, betting against the dollar.
When Monday morning arrives, the market opens drastically lower against his positions. The futures markets on the exchange hit their daily allowable downside limits instantly. They are locked limit down.
He is trapped in a burning building and the exits are bolted shut. He can't sell his futures contracts because no one is legally allowed to buy them at a lower price on the exchange.
Exactly. But instead of holding, hoping, and praying that the futures market would eventually bounce when trading resumed the next day, McKay immediately pivots.
He goes outside the exchange entirely. He turns to the over-the-counter interbank cash market, the decentralized network Lipschutz operated in, which has no daily limits, and he aggressively dumps his entire currency exposure at an 1,800-point loss.
He absorbs a $1.5 million hit instantly.
The emotional discipline there is staggering. Most people would wait, rationalizing that the interbank price is an overreaction and the futures market will provide a better exit tomorrow.
But McKay's core rule was absolute. When you get hurt in the market, when the thesis is fundamentally invalidated, get out immediately. Don't negotiate.
Because once you are deeply in the red, your cognitive objectivity completely vanishes.
Yeah.
You are no longer trading the mathematical reality of the market. You are trading your own emotional pain and hope.
Unfortunately, humans are not machines. Even McKay violated that exact rule 10 years later, and it cost him dearly.
It's 1988. He is heavily long the Canadian dollar, holding 2,000 contracts. He is up millions on the year. This is supposed to be his swan song, his second-to-last trade before he retires with $50 million to go buy a professional baseball team.
He's down in Jamaica overseeing the construction of a house. On his way to the airport to catch a flight, he stops to check a, quote, screen and sees the Canadian dollar is down 100 points in the Far East overnight session.
Now, a 100-point drop in a single night for the Canadian dollar was practically unheard of. It's a massive statistical anomaly.
His rules dictate he should immediately find a phone, call his broker, and liquidate the position. But instead of acting, he rationalizes.
He tells himself it must be a data error. It's a typo on the screen. He gets on the plane, totally disconnected from the market for hours.
But it wasn't a typo. There had been a crucial, unexpected political debate in Canada between Prime Minister Brian Mulroney and John Turner.
Turner unexpectedly dominated the debate, suddenly putting the Canadian election and a massive, highly anticipated U.S. free trade agreement in total political jeopardy.
The currency market collapsed in response. By the time McKay gets off the plane and finds a public payphone, the position is hemorrhaging. He's down $3 million.
And he hesitates again. The guy who took a $1.5 million loss instantly in 1978 is now frozen. By the time the pain becomes so unbearable that he finally capitulates, he loses $7 million.
So let's analyze this. Why did a veteran trader who fundamentally knew better completely freeze?
It wasn't a lack of knowledge. It was cognitive dissonance caused by an overwhelming attachment to the outcome. He had already mentally spent the money. He was fixated on the finish line, retiring with his $50 million and his baseball team.
That psychological attachment overrode his operational discipline.
He wanted the trade to be a winner so desperately that he allowed his brain to invent a typo to ignore the glaring reality of the 100-point drop. It is a powerful reminder for anyone pursuing a major goal. The moment you become emotionally invested in the destination, you lose sight of the mechanics of the road you are driving on. And that's exactly when you crash.
Which brings us to McKay's ultimate survival tool to prevent those crashes. His dynamic position sizing. He balances his natural risk-taking personality. This is a guy who climbs mountains in Africa and trades millions of dollars with an ultra-conservative, disciplined, Catholic seminary upbringing.
He uses incredibly strict money management algorithms on himself. When he is hot, when his subconscious jade recognition is perfectly aligned with the market rhythm, he might trade 3,000 contracts.
But when he hits a cold streak, when he takes a few losses, he doesn't do what the amateur gambler does. He doesn't double down and try to win his money back with a massive revenge bet.
He brutally slashes his trade size down to 10 contracts.
That is the mathematics of long-term survival. He treats his own performance as a trend to be managed.
When your psychological capital is depleted from a string of losses, your decision-making is inherently impaired. You begin trading on hope and fear, not objective analysis.
By drastically reducing your bet size during a drawdown, you limit the damage. You allow yourself to stay in the game, enduring the inevitable cold streaks without blowing up your account, treading water until your mental clarity and market alignment return.
Speaking of mathematics, let's bring in our final wizard for today, William Eckhart.
This guy operates on a completely different intellectual plane. He was a few credits shy of a pure mathematics PhD at the University of Chicago, got bogged down in internal faculty politics, took a sabbatical to trade on the floor of the exchange, and never went back.
And Eckhart brings a level of rigorous academic mathematics to trading that totally dismantles a lot of Wall Street's conventional wisdom.
He is a fascinating contrast. Interestingly, he openly admits that his early success as a floor trader wasn't because of his brilliant overarching math theories. It was simply a mechanical advantage called the skid, the execution edge.
As a local trader physically standing in the pit, buying on the bid price and selling on the offer price, he was acting like the house in a casino, constantly capturing the tiny fractional spread between retail buyers and retail sellers.
It was a physical grind. But when he eventually transitioned off the floor to become a computerized systemic trend follower, his deep mathematical background became his ultimate weapon.
Eckhart argues something about market structure that sounds completely terrifying for the average investor. He explicitly states that market prices do not follow normal bell curve statistics.
He cites the legendary mathematician Benoit Mandelbrot to claim that financial price distributions are pathological and have what he calls infinite variance. Now, I'm going to need you to translate infinite variance into plain English for me and the listener. What does this actually mean for reality?
It is one of the most profound concepts in risk management. In classical statistics, which assume a normal bell curve distribution, like the distribution of human heights, extreme outliers are incredibly rare. You will almost never see a human who is 10 feet tall. The boundaries are contained.
Makes sense.
But Eckhart uses a famous coin toss analogy, rooted in the St. Petersburg paradox, to explain markets. Imagine a random walk generated by flipping a perfectly fair coin. You keep track of the waiting time between ties, the moments when the total number of heads perfectly equals the total number of tails.
Usually the wait is short. You flip heads, then tails tie.
But occasionally heads gets way, way ahead on a streak.
Right, you flip 10 heads in a row, it's going to take a long time for tails to catch up and tie the score.
Exactly. In a truly random walk with infinite variance, the average waiting time between those ties has no mathematical ceiling. The longer you play the game, the larger the sample average grows. The streaks of deviation can theoretically extend forever.
So bring this down to earth. What does this infinite variance mean for the listener who is just trying to protect their 401k or their retirement account?
It means that if market variance is infinite, the extreme tail events, the catastrophic 100-year floods, like the 1987 Black Monday crash where the market dropped 22% in a single day, or the 2008 financial crisis, will happen far, far more frequently than normal bell curve statistics predict.
If you build a trading system or a corporate risk model or a retirement portfolio based on the assumption of a normal distribution, your true risk is massively understated.
You are effectively building a heavy stone house on a fault line, using structural materials rated only for a gentle spring breeze.
Therefore, Eckhart argues you need highly robust statistical tools. You need blunt instruments and conservative leverage that assume the absolute worst-case scenario is lurking right around the corner, not delicate, highly optimized mathematical models that assume the market will always revert to the mean.
He also uses this mathematical rigor to absolutely shred popular technical analysis, particularly the visual chart patterns that so many day traders rely on.
He specifically goes after people who use 45-degree angles or Gann lines drawn on a computer screen to predict support and resistance. He says it is complete mathematical garbage. Why?
Because the angle of a physical line drawn on a chart changes entirely depending on the arbitrary scale of the x and y axis. If your software compresses the time scale on the bottom or expands the price scale on the side, a 45-degree angle suddenly becomes a 60-degree angle.
It has no intrinsic mathematical reality. It's just pixels on a screen.
This is where human biology and psychology betray us again. Humans are biologically hardwired to be pattern recognition machines. It's how we survived in the wild. We look at random clouds and we see faces.
We look at random, chaotic price fluctuations on a chart, and our brains desperately impose predictive shapes, head and shoulders, triangles, flags.
Furthermore, we fall victim to confirmation bias. We intensely remember the one time a magical indicator perfectly called a market top, and we conveniently forget the 99 times that exact same indicator generated a false signal that would have bled our counts dry.
Eckhart argues firmly that if a market pattern cannot be reduced to a strict programmable algorithm that backtests positively over decades, it is simply an illusion created by your own cognitive biases.
Which leads perfectly into what he calls the call of the countertrend. This is the inherent, almost magnetic human desire to buy things when they are cheap and sell them when they are dear.
We instinctively anchor our minds to what we consider a normal or fair price. If a stock drops 30%, we want to buy it because it feels like it's on sale. If it skyrockets to new all-time highs, we want to sell it because it feels too expensive.
Think about your own decisions. Have you ever bought a stock simply because it was down from its high and looked like a bargain? Eckhart is saying your brain is tricking you into stepping in front of a freight train.
This touches on the foundational work of behavioral economists like Kahneman and Tversky regarding prospect theory.
Decision theorists have conclusively proven that humans have a totally irrational, asymmetrical relationship with risk and reward. If you offer a human a guaranteed $500 or a 50% chance at $1,200, the vast majority will take the sure $500, even though the mathematical expected value of the gamble is technically higher.
We prefer to lock in a sure, small game.
But if you flip the scenario to losses, our behavior inverts entirely. If you offer a human a guaranteed $500 loss or a 50% chance to lose $1,200, they will almost always take the gamble to avoid locking in the sure loss.
We become risk-seeking when facing a loss and risk-averse when facing a game.
This is the exact opposite of what a successful trader must do. Amateurs go broke taking large losses because they stubbornly hold on to losing trades, gambling that they will bounce back to break even.
Professionals, on the other hand, go broke taking small profits because they cash out their winning positions far too early, missing the massive, infinite variance trends that are mathematically required to pay for all the inevitable small losses.
It is the ultimate psychological paradox. To succeed, you have to act completely unnaturally. And Eckhart insists that to build this unnatural discipline, you must physically feel the pain of a loss.
He notes that traders who start out playing with inherited wealth almost always blow up their accounts. Why? Because losing $50,000 of inherited unearned money doesn't physically hurt them. They don't have their hand on the hot stove.
If you don't feel the visceral pain of a mistake, you develop no behavioral survival mechanism. You will let the loss grow until it destroys you. But the deep paradox here is that trading as a profession is financially positive for the successful, but emotionally negative.
The elation of a massive profit does not generate enough dopamine to offset the crushing psychological distress and cortisol spike of a massive loss. The pain always outweighs the joy. You are choosing a life of managed discomfort.
So bringing this all together for you listening, whether we are looking at Bill Lipschutz leveraging deep global banking relationships to navigate a $3 billion geopolitical shock,
Or Randy McKay drastically shrinking his bet sizes to survive the cognitive dissonance of a massive error.
or William Eckhart using blunt force probability to deconstruct our innate pattern recognition biases. The ultimate battleground is not the Chicago Mercantile Exchange or the interbank network. The ultimate battleground is the human mind.
That is the defining takeaway of the entire Market Wizard's philosophy. The market is merely a highly efficient mechanism that aggregates and amplifies human emotion, greed, fear, hope, and panic.
The rules these elite operators use aren't just about managing financial capital. They are about managing psychological capital. Ask yourself, in your own life, your career trajectory, your personal relationships, are you holding on to a losing trade just to avoid the momentary ego pain of admitting you were wrong?
Are you imposing patterns on random events to justify a decision you've already made emotionally? Are you operating with scared money, making decisions out of desperation rather than clarity?
Are you jumping off a winning trajectory in your career or a project way too early simply because you're afraid the success will vanish and you want to lock in a small win?
The principles of strict risk control, aggressively accepting small losses, and fighting the biological urge to countertrend are universally applicable to any complex environment.
But there is a chilling corollary to all of this that we must consider. Eckhart leaves us with a fascinating, almost science fiction prediction. If human nature, our volatile emotions, our cognitive biases, our biological risk aversion is the greatest flaw in the trading system, then the logical conclusion is that the perfect, ultimate trader of the future will not be human at all.
Eckhart predicts the ultimate trader will be a cybernetic automaton, A purely rational artificial intelligence that simply doesn't feel the agonizing pain of a loss, doesn't panic and freeze during a 100-year flood event, and doesn't see phantom faces in the clouds of market data.
Which brings us right back to our opening thought. If this staggering trillion-dollar daily market is currently driven by the friction of human irrationality, what happens when the machines finally optimize away the very inefficiencies, the panics, and the biases that allowed these human wizards to make their millions?
Will there be any edge left for the human mind? Or will the algorithms simply trade against themselves in a perfectly efficient, perfectly emotionless vacuum? It is a fascinating question about the future of human intuition, something for you to mull over until next time.